Right now, let's welcome back our good friend, John Najarian. He is a man we always feel fortunate to have when talking about the financial markets. John Najarian started his career as an options trader at the CBOE in 1981, following a stint as a pro football player with the Chicago Bears. John and his brother Pete are the co-founders of OptionMonster.com, a provider of market intelligence, commentary, and strategies. He's a regular on CNBC's Fast Money and is always in demand as a speaker and market analyst. John, welcome back to the show. It's good to have you.
Great to be with you, David. Thanks for having me back.
So tell me, generally speaking, what's your take on what's happened with the stock market starting on Groundhog Day of this year?
Well, yeah, it seems that the market really had gotten ahead of itself in January, David. I know you've said that, and other astute market watchers have said that the trees don't grow to the sky. You don't just put on 100 points on the Dow Jones Industrials every single day for a month straight, which is more or less what we did. Yeah. And you haven't had any corrections of any significance in years. So we were due for some volatility. Boy, did we get it in spades. And then we had a bunch of reasons, like, for instance, the departure of Gary Cohen and other things that have happened recently, tariffs and the like, that have sort of given investors pause, I'll say. Mm-hmm.
So I know you talk about January, but even if you look back throughout all of 2017 being a 20% plus year, 30% depending upon what index you're actually quoting, the question is how much of these drops, how much is volatility that occurred in February really came from the news? Or is it really just, as you said, the market getting out over its skis over the last maybe even more than a year? And these particular newsworthy items are really just an excuse for the market drop by the Monday morning quarterbacks?
Well, I think it was that the market was very robust and very strong. And a lot of that I give credit to President Trump and some of the rollback in regulations, obviously continued low interest rates. But that, David, is what changed on Groundhog's Day, as you're saying, because all of a sudden we saw a pretty big jump in interest rates. And when you're talking about rates that back in November were 2.25 for the 10-year rate, and all of a sudden it touches 2.90 very quickly in February, that was something that was a wake-up call for the market. If all of a sudden I can make almost 3% on a 10-year instead of 2.25%, that's a little bit more of a draw of capital away from the stock market. Doesn't mean everybody should leave, but that was a wake-up call, I think, for investors.
Well, what do you think was different then? Because we saw a 75 or 80 basis point jump in a month or 6 weeks right after the election. But it was hardly a hiccup on the stock market, on the bond market. But all of a sudden this time, a 60 basis point jump, it really affected both stock and bond markets. So why do you feel like it was different this time from maybe 14 months before?
I think 14 months before, we still had the Fed that was basically at zero interest rates. And since then, they've moved now 5 times. I mean, they've taken the Fed funds rate up to, over 1%. Mm-hmm. And I think, David, that tells me that when we pull back, we can't pull back as far, because when the interest rates were zero, you could pull all the way back towards zero. And we'd seen, not the 10-year, but we'd seen the short-term rates do exactly that. Mm-hmm. Now, when we pull back, we're pulling back towards that 1 or 1.25. That's as far as we can go. So I think that's why the market just can't fight the Fed as much now at 1.25% rates as it could when the rates were zero.
So it sounds like you're saying that you thought that it was, the market seemed to think that was more of a temporary thing after the election because short-term rates weren't below it supporting it. But now that short-term rates are supporting it, the markets are saying, uh-oh, this is permanent, not temporary. So we need to take a quick commercial break. We come back, John, I want to ask you a little bit about how that affects stock market valuations and what your anticipation is of the months coming up in terms of market volatility. So and you stay with us also. We'll be right back with a lot more in terms of words of wisdom from my good friend, John Najarian. We'll be right back. First, let's welcome back John Najarian. John, thanks for sticking around.
Great to be back.
Well, glad to have you as usual. And I know we, last week's show, we talked about this, and I know you saw it because I know that you sit home every Sunday morning and you watch our show here on Newsmax. But we talked about the fact that it's funny because everyone talks about how interest rate increases affect the bond market. But in some ways, interest rate increases have as much of an impact on the stock market as the bond market, because the stock market is really a discounted future earnings flow. So what do you think this interest rate trend means for the stock market over the next few years?
Well, what I've liked to say, David, is that it's the acceleration or the speed, the velocity of interest rate increases. We all know that the Fed is going to be increasing rates unless something bad happens, which obviously none of us are rooting for that. But when we see that big jump, you said after the election that we had that 60 or 70 basis point jump in the 10-year. You're 100% right. It happened very quickly again from November of 2017 till basically the first week in February. And it's those quick moves that startle the markets. So I think overall it's undeniable that interest rates are going higher. But I think if they go higher at a slow and measured pace, I think that's something the market will tolerate. The market won't tolerate it if they go up quickly.
Yeah, and it's interesting because the Federal Reserve, I believe, they're smart enough that they're not going to have quick short-term hikes in interest rates. But the long-term rates stimulated by the markets, you just don't know. And this one we had in the past month was obviously just the bond market itself reacting quickly. So I guess the question is...
Exactly right. That's why we watch it.
Of course. And John, I guess the question then is, what does that do to investors psychologically? You know, a football team with an offensive coordinator and no defensive coordinator doesn't make a very good football team, right? Well, the problem is a lot of investors over the last year seem to have forgotten about defense. It's almost like defense doesn't matter. You know, we're just going to get the ball, we're going to throw it down the field, we're going to score a touchdown every time, don't worry about defense. So were they unprepared for this market pullback? Are they unprepared now? What are your thoughts to that?
Well, we all saw in the Super Bowl that Tom Brady scored as often as you could possibly score in that game, threw for 500 yards, and they still lost. So to your point, you do have to be able to do something more than just score frequently. You do have to have a defense. So to take it back to the stock market, I think a lot of people could just have thrown money at the market in 2017, and they were going to be up 20% or more unless they just really picked the dogs that were out there. They could do much better than that, of course, if they picked the right stocks. However, I think that kind of spoils people. They think, oh, anybody can do this. Yeah. What do I need to pay David for? What do I need to pay John for if I can just throw money at the stock market and make 20%? That changed in February. Now there's a lot more demand for people to get a little help, whether it's defensive help or whether it's, you know, advice that, hey, it's a good idea to take a little off the table here and look for another spot for some of these assets.
Well, you heard me say, don't try this at home, and that's exactly the point here. Do you think the volatility is going to stay at this higher level throughout the rest of 2018 as a best guess? I mean, I know you don't have a crystal ball, but what are your thoughts on that?
No, I don't think it's going to stay high. I do think that if we see that acceleration that you and I talked about just a moment ago, if the velocity of change in interest rates is high, then we'll see high volatility as well. If we don't, then I think we won't be as low as we were in 2017, which was, I think, the lowest year on record for volatility. But I do think volatility will be more in that 14 to 16 range, not in the mid-20s that we just saw a week ago for the VIX. Yeah.
20 seconds or less. Do you think the market has more downside throughout the year of 18 or more upside at this point?
I think it's got more upside in 2018. I think that when Joes and Janes start cashing those bigger checks from the tax cuts, I think that will be a driver as well as corporate profits, David.
You know, that was my opinion going into beginning of February and when the drop first started, and I'm questioning it a little bit now, but hopefully you're right, John. So, John, stick with us. We'll be right back for one more segment. Let's welcome back John Najarian. So, John, you know, what do you think for most investors then in 2018? Do you think it's more of a, you know, running the ball 3 yards, 4 yards, and that's it? Or do you think more of it's, you know, passing the ball 15, 20 yards down the field, trying to get the first down all in one fell swoop?
Well, I think there'll be a lot of the latter because of M&A, David. So in other words, we've seen this year already a number of big deals announced. I mean, Cigna going after Express Scripts, a $67 billion deal. I'm not saying they'll all be that size, but I think you'll see those kinds of jumps out of the companies that are being acquired. So to your point, to me, that's more like throwing the ball downfield.
Sure.
I think for a lot of stocks, though, like Apple, I think it'll be, 3 yards in a cloud of dust. But I think they just keep thumping away and going small moves higher for a lot of the Dow Jones Industrial stocks.
Okay. So let's talk about hedging then. Like I said, I was thinking that we're going to have more of a blow-off throughout this year and maybe even 2019 when the first pullback happened right around Groundhog Day, as I said, and then I've been starting to question that a little bit more. So let's say that people watch my show, so they kind of agree there's a great chance that we're going to have more of this uptick, but they want to be cautious. They want to hedge. What's the best way today for you to recommend people hedge with the volatility? Stop losses or options? Are the options too expensive?
I'm always going to say options, David.
I kind of thought you might.
Question, I know, because you're a smart host. But yeah, I'm going to say options, and I'm probably going to say options on the S&P 500. Those would be puts. So with people with exposure to the market that have stocks that are S&P 500 or S&P 500-like stocks, then I'm going to buy some out-of-the-money puts in the S&P 500 just in case. I think for the same reason you want that kind of insurance on your car or your house. And just like the insurance on those, you hope that you don't crash your car and that those puts go out worthless. I don't want to root for those puts to explode. I want to root for them to go out worthless. So I think the market continues to grind higher, but I'd like to have a little protection. That would be my hedge.
So, what's your best guess if you were hedging in a blanket way with the S&P 500 today? How far out would you go, and what percentage below current market value would you put your strike price? Just give us some feel for that.
Sure. I would, and I routinely do this for customers, I would, or our team does, technically, I don't, but we buy usually 2 to 5% out of the money puts that are usually 2 to 3 months into the future. So in other words, if we're talking here in March, I'm usually picking something that's more like a June timeframe, May or June, and I'm picking several strikes out of the money in the S&P. They're cheaper then, and the time decay is going to be very slow on something like that. The nearer term options look cheap, but they're really a lot more expensive if you figure how many times over the course of the year that you'd have to buy them.
Yeah, and I guess if you get a bigger pullback, so the option's now in the money, you could always turn around and sell that and create a gain at that point too. So there's ways to hedge, and you could flip it into a great way to be speculative and make money. So that's all good news. And John, we have to leave it there for now. I appreciate you being with us again today.
All right.
It's more saying that time really does fly when you're having fun. So John, thank you.
It did. Thank you, David.
And you stay with us also. We'll be right back in just a bit with our next guest, Dr. Doom himself, Mark Faber. So stick around.